Hi, I'm Kathie pfeffer-Hahn. Welcome back to my channel. Hiring a financial advisor can offer a multitude of benefits that extend beyond one's financial understanding. First and foremost, a skilled financial advisor provides expert guidance tailored to your individual, unique circumstances and goals. They should possess a deep understanding of complex financial concepts, investment strategies, tax implications, and retirement planning, which can be overwhelming for the average person to navigate on their own. But they can analyze their client's financial situation comprehensively, and as an advisor, they can develop a personal roadmap that aligns with the short-term needs and the long-term aspirations for their clients, fostering financial security and peace of mind. Additionally, a financial advisor serves as an accountability partner, encouraging individuals to stay on track with their financial objectives. This external support can be particularly valuable during times of uncertainty or market volatility, as the advisor's expertise helps to counter emotional decision-making and impulsive actions. Moreover, financial advisors can help clients optimize their portfolios by diversifying investments and minimizing risk exposure. That way they can potentially enhance returns over time. In essence, hiring a financial advisor not only streamlines financial decisions, but also empowers individuals to make well-informed choices that pave the way for a more stable and prosperous financial future. But how do you choose the best advisor for you? Every person's needs are different. Do you have kids? Do you want to travel? What do you want to leave for your family? Today I'll go over questions that will help you choose the best advisor for you. But before choosing your advisor, you're going to need to understand the following 10 things. The first question you're going to want to ask your advisor is, how are you going to get paid? There are a few ways that they may collect their fees. They may charge you by the hour, charge a flat fee, or a percentage of your account. They may charge you based on how much you have invested with them, and they may reduce their fees the more your account grows. So if they charge you 1.5% management fees and you have $500,000, you'll owe them about $7,500 a year in fees. But if you gain money, raising your balance to say $1 million, the investment charges could go down to 1%. So then you would owe them $10,000 a year in fees. Frequently, these fees are billed either quarterly or monthly. They may also add in a fee if both of you agree to a bonus where they have to perform to a certain standard, like getting a certain return on investments. Another way they may charge you is by earning commissions when you buy certain funds or products. They earn a percentage based on how much you have invested, so make sure you really need that product or that it's in your best interest for your situation in the market, not just because they earn a profit. Be careful, because these advisors may not be working for your best interest. Lastly, there might be some who earn a salary if they're working for a firm that has advisors working for them. The second question to ask is, are they willing to meet with you? Whether that's virtually or in person, and whatever's best for you will be what you're looking for. Ask when they're available for calls and what their hours are. The third question is, how do they allocate investments? Do they recommend a diversified portfolio that includes a little bit of these types of investments? One which has large cap or capital companies over $10 billion in total market value, mid caps which are between $2 and $10 billion, small caps which are less than $2 billion, international securities, these are companies listed on international exchanges, emerging markets, and these are issued by companies that are in developing nations, fixed income securities, which are highly rated corporate or government bonds that pay a set amount of interest each year, or money market investments, which are short-term debt that you purchase. You could also get REITs, which are real estate investment trusts, and that's where you put your investment into a pool of mortgages or properties. Because what you're looking for is a way to minimize risk while maximizing return. The different assets have different risks associated with them. More return comes with taking more risk. Another consideration in investing is asking yourself, how soon do I need the money? If you'll need it within the next 5 years, you'll probably want to choose a less risky portfolio than if you have more time to invest. The fourth question is, are you a fiduciary? And this means that your advisor will have to act in you, their client's best interest. They'll do this by managing your money and property carefully, worrying about only making choices for your portfolio. They'll keep you and your heirs in mind, offering only products or services that will benefit you. They'll of course be doing this for each of their clients, but they'll be looking out for their client's best interest. Question number 5 asks, what are your qualifications? You should expect at least a bachelor's degree in finance, marketing, or business, and they should be able to sell securities, which are stocks and bonds, and they'll have to have passed General Securities Representative License called a Series 7. It covers all basic investment knowledge and the regulations around selling them. A Series 63 license, called a Uniform Securities Agent State License, will allow them to sell across many states. Finally, the Series 65 license covers the Financial Industries Regulation Authority, and it's for advisors who charge an advisory fee. A certified financial planner has to pass the CFP exam to be able to use that designation. They're tested on their ability and aptitude for a comprehensive, holistic approach to financial planning. They really do work for your best interest. The number 6 question asks, what are all of your costs? This question is meant to make sure that there are no hidden fees and that you're made aware of each and every possible charge that they might pass on to you, because fees can start eating at your savings without you even knowing it. Question number 7, do they work with your investment philosophy? The question seems a little unnecessary because if they're fiduciaries, they need to respect your style of investing and follow what you want done. But they should offer guidance with you and tell you what options are available. Instead, I would ask, do you provide education? In other words, do they honor that you're still trying to understand how all of this will impact you and be willing to slow down and explain what they're doing? This is another great reason to get a certified financial planner, as they'll create a full document explaining what they're suggesting with options within any class of investing, how it will affect your taxes, what insurance you need, and how it will affect your retirement and estate planning. They really are a worthwhile relationship to have. Question 8 asks, how do they benchmark their success? They should be able to explain how they're measuring success in all areas of your investments, not just against the S&P 500. That only measures large cap investments, and they should be comparing how they do versus whatever benchmark for your certain security. So for example, if you're invested in international securities, they should have a benchmark, whatever you're trying to beat, against international security baseline. The 9th question is, who is your custodian? This is the company that will actually be holding your money and investments. You'll want to hear that they've hired an independent custodian to hold your investments. They should be able to tell you how your investments are doing and be able to show you immediately. The custodian needs to be a broker-dealer, a bank, or another qualified custodian according to the Securities and Exchange Commission, or SEC. The website at sec.gov has a great deal of information on investing protection and regulations in security markets. It is not an easy read, but it's thorough. And finally, question number 10. What are the tax implications of investing with you? Ideally, they're qualified to have your return prepared for you, but they'll need to be able to sit down with you and explain how they'll minimize your tax liability. They should know your financial goals and unique situations. It's okay if they lead you towards a separate tax professional, but you should know before your taxes are due what their advice will mean for you and what you'll owe at that time. I can't emphasize enough that you're going to want both education and a relationship with whomever you're giving your investment money to. You need to understand how all of your assets are working for you and how it's going to affect you and your retirement future. This has been Kathie Pfeffer-Hahn. Thanks for watching. Please leave a comment on the question that makes the most sense to you or the one that you had not yet thought to ask. Please hit subscribe and ring the bell so you're alerted to my new videos. Thanks again for watching.